Hello, and welcome to another edition of Enquirica Research Presents. Today on Enquirica TV, questions with product issuers. Hello, and welcome to another edition of Enquirica TV's Questions with Product Issuers. My name is Rick Purdy, and thank you for joining me on the program today. Questions with Product Issuers is an opportunity for investors to learn more and get a better understanding of alternative investment opportunities in the exempt market. The format of the series is to ask a standard set of macro and microeconomic questions of every issuer so that our viewers can get a consistent and unbiased overview of the opportunities available. Now, the first question for our guest on today's program is, tell our viewers the elevator pitch for your investment.
Hi, I'm David Judy, founder of Capstone Real Estate Corporation. Capstone was established in 2004, really for the sole purpose of helping investors diversify their investment portfolios with real estate. We found that it was an asset class that very few people had utilized in the past and very few people had access to. So today, we're actually on our 9th offering with Capstone, and our second offering in the last 12 months in the Phoenix area, where we're actually specifically focused on single-family detached houses that provide cash flow and a great opportunity for appreciation.
Now, if you could share with our viewers, what are your key macro drivers?
You know, the key focus for Capstone prior to launching Saguaro Series 1 and now Saguaro Series 2 was identifying that there was a great opportunity in the U.S. market to take advantage of events that had happened over the last 3 to 5 years. Our core objective is always focused on two things. One is we want substantial opportunity for capital appreciation, meaning we want to buy significantly below current market value. But just as, if not more important, is that we want to create consistent, positive cash flow. So we want a tangible asset that we know has value substantially greater than what we paid for it, and we want to make sure that we're creating cash flow that just basically pays for us to wait to realize that capital appreciation. The U.S. as a whole seemed to provide some substantial opportunities. We had a market that had decreased in value in some areas by 40 to 50%, and we had an underlying driver being adjustable rate mortgages, where there were a number of people who were heavily leveraged in that market, decided to give their homes back, which provided a substantial amount of supply into the market, and very little demand. Most of these people gave back their homes. They couldn't qualify them for a mortgage right away, but they needed somewhere to live. So we felt that that provided us with a real opportunity on a macro level to look into the U.S. And then specifically what we needed to do was we needed to find out where's the best place for us to focus our attention and invest.
And what are your key micro drivers for your investment premise?
Well, there were 5 states that were hit harder than any other when it came to foreclosures in the U.S. market. Michigan, Florida, California, Nevada, and Arizona. We needed to look at those 5 states in detail and figure out where were the best opportunities. Michigan, well, you know, I think there's a whole lot more challenges in Michigan, just the housing market. So that wasn't an area we focused a great deal of attention on, but we did focus a lot on Florida and California. We still believe that there are some great buying opportunities in those markets. But because our model is focused on positive cash flow, our expenses have a lot to do with what the decisions are that we make. And property taxes are a major expense. In both of those states, they have what's called non-resident property taxes. So as investors, corporations, or non-U.S. or non-state residents, we pay significantly more in property tax than our next door neighbor would. And when we ran those cash flows, those two markets just did not make sense today. The other 2 markets that we were left with were Nevada and Arizona. Nevada and Arizona, really, it's focused on 2 cities. That's Las Vegas and Phoenix. There's some great opportunities in Vegas. One of our challenges was it's an economy that was really built on construction on the Strip. If you went to Vegas in the last, probably 3-4 years ago, you noticed the entire Strip lined with cranes, new construction, lots of activity. And that's why the economy was thriving in Vegas. If you've been in Vegas the last 3 to 6 months, obviously that's a little different situation. There are virtually no cranes, and employment's really, people had a real challenge finding employment. So our last and where we are today, we focused on Phoenix. Why? Well, property values in Phoenix decreased by 35 to 50% in many areas, but extremely strong economy, a growing population base. As a matter of fact, Phoenix has been one of the 5 fastest growing cities in the U.S. for 15 consecutive years. So we're always looking for a market that, yes, we can buy at a significantly below market, but more importantly, we're going to have renters. Because if you have renters, you have cash flow. And that's really what our focus was in moving into that Phoenix market.
Explain in detail how you make investment decisions.
There are basically 4 key criteria that we use when we're making investment decisions. The first one is that we always want to pay under current market value. The way that we purchase assets and the relationships that we establish are key to us paying 20 to 25% under what the current market is. The best people to buy from are motivated sellers, I mentioned earlier, and we're buying directly from the bank. If we're buying directly from the bank, we want a deal. The second thing that we're concerned about is we always want cash flow being to dictate everything that we're purchasing. We use what's called the 1% rule. It's interesting, if you talk to a real estate investor 50 years ago, they all talked about the 1% rule. The 1% rule is if I bought a house 30 years ago for $50,000, I wanted to ensure that I could rent that house for $500 a month. And that was just a simple rule of thumb that every old-time real estate investor used. Unfortunately, in this country for the last 30 years, it's been very difficult to use the 1% rule. But every single asset that we purchase in the Saguaro Series 2 portfolio meets that 1% rule. If we're only able to generate $1,000 a month in rent, we will not pay any more than $100,000 for that home. The third thing we want to do is we want to only buy assets that we can keep vacancy levels at as low a rate as possible. And the key to that is you want to cater to a particular market that is in the need of rental. In the Phoenix market, there's a whole lot of young families that unfortunately have had to give back their homes to the bank and are looking for another residence to live in. Rental demand is at an all-time high in the Phoenix market. What's very interesting is most of these people are not moving away. They're giving their homes back and they're moving down the street. They want to keep their kids in school. They want to stay close to their friends, and they want to stay in the same neighborhood. So how do we buy an asset that caters to those individuals? And we're also going to make our investments decisions based on where can we get quality property management. We only want to go into areas that we feel have the ability for us to partner with good partners in the property management side of the business. They're going to help us select quality tenants and make sure that the homes that we're purchasing are quality homes and they're kept in good order. Because of course we don't want to hold these homes forever. We want to have them as assets that we're going to liquidate at the maximum price possible down the road.
Now, one of the most important things for investors is, what is your exit strategy?
You know, at Capstone, we always have an exit strategy before we start an offering. Believe it or not, that's not the way the vast majority investors invest. Normally people invest and they go, geez, if I could just get as much as I possibly could out of this particular asset, I'm going to be really happy. It's much the same as you go to the cocktail parties and someone's talking about the stock they bought, the IPO for $1 and it was worth $100. But they never talk about they sold it for $100. They say it was worth $100. In most cases, they're selling that asset for $1.50 if they're lucky. In our case, being disciplined, not only in how we purchase assets, but when we sell the assets is the key. We don't want to be trying to time the peak of the market. We want to be selling in a market that's in an upswing, and we want to be taking advantage of that fervor that people have going, I got to get in, I've got to buy. And we're always going to leave money on the table for the next person. That's good business, but it means that you're going to sell assets quickly, and you're gonna sell in an uptick market. Our exit strategy for Saguaro is really based on a calculation of price per square foot. Our belief is that we don't need markets to go back 4 years, 5 years ago, almost 6 years ago now, was really the peak of that Phoenix market. And homes were selling for around $200 to $225 a square foot. That's significantly less potentially than we'd be buying homes in Canada, but that was an all-time high. Today, we're purchasing properties in Phoenix. Our average purchase price per square foot today, we have 33 homes in Saguaro Series 2 portfolio, is approximately $49 a square foot. The market average today per square foot is $84 a square foot. So as mentioned earlier, we're purchasing significantly below current market. Our exit strategy is that average price per square foot goes from $84 to $100 a square foot. And we will start to liquidate the portfolio at that time. We feel that will crystallize substantial gains for our investors, and we're not going to be worried about trying to time the top of the market again. And by the way, that exit strategy is approximately 50% of what the average price per square foot was just 6 years ago.
What do you believe is your margin of safety?
Sure. You always want to consider when you buy an asset, what is your margin of safety? Real estate actually is a very unique asset in that, I usually look at my margin of safety as I can go kick the dirt. And I think that's one of the real advantages of buying real estate, is that it's a tangible asset. You're not buying, a piece of paper that has some numbers and names on it, and you say, well, hopefully if I go to market, I'm going to get X number of dollars. It's a tangible asset with value. You mitigate your margin of safety by time. If that asset is producing cash flow, quality cash flow, you wait and you let market conditions take care of themselves. So by buying a tangible asset with real value, that's the best way to protect yourself. But where do you buy it? Well, you only want to buy in markets where you know you're going to generate cash flow, and you generate cash flow through renters. So you want to be buying in an area where the economy is doing well. Phoenix, by the way, its unemployment rate is significantly below what the national average is today. You want to buy where the population base is increasing in that marketplace. Phoenix population, like I mentioned earlier, one of the 5 fastest growing population bases in the U.S. for 15 consecutive years. And you want to buy an asset under current market value, because nobody's always 100% right. We're never always 100% right. But if we've got 20 to 25% to work with because of how we bought that asset, it definitely mitigates your downside risk.
Do you use third-party leverage or bank financing? If so, why and how do you perceive this affects the risk profile of your investments?
Yeah, we have a lot of our investors ask us if we're utilizing leverage in our Saguaro portfolios. The quick answer is no. As a matter of fact, none of our portfolios in the past have we utilized leverage. But I'm always careful in answering that question. Our offering does allow us to use leverage. And I think that if you can find quality terms for leverage, and your cash flow is going to produce quality returns over and above those leverage costs, then utilizing leverage to invest in real estate makes sense. But you want to be very selective. One of the challenges in the market today is that you can't easily access capital in the U.S. market, especially the U.S. housing market, which is understandable because of what's happened. So the terms that we've looked at just don't make sense from a leverage perspective. But I think it's important to understand if we did utilize leverage in the future, we'd want rates below our 6% threshold, obviously. We don't want to pay significant points, which means that we're not going to pay huge brokerage fees to secure that leverage. And your loan-to-value ratio is a really important piece to keep in mind. To actually increase your rates of return slightly by using a very low loan-to-value ratio makes sense. But when people run into problems with leveraging in real estate, it's when they started doing what they did with adjustable rate mortgage. You start loan-to-value ratios over 60, 70%. That's not quality investment, that's speculation, and we're not in the business of speculation.
Now, if you could tell our viewers in detail about the founders, their backgrounds, past successes, and operational experience in the current area of investments.
Sure. I'll tell you a little bit about the founders. The founders